Hello, and welcome to our fourth office hour. Today, we're going to talk about politics and profits, what really drives the market. We got a big election just 2 weeks away. A lot of people talking about it, a lot of stuff on the news, a lot of phone calls, text messages, a lot of controversy in this election. So does the election really affect your investments? Should you be making adjustments? If so, how? Let's talk about it. First of all, do elections really matter? Elections every year, it seems like, right? Local elections, there's midterm elections, there's presidential elections. How do elections impact the market, and what does history tell us when it comes to that? Disclosures, obviously, anything we talk about today is not considered advice, just good information. We want to look at specifics on any given portfolio for a client before we tell them what they should be doing and adjusting their investments accordingly. So the S&P is posted lower returns overall in presidential election years, right? So presidential election years, the average return 11%, median return 14%, non-election years 11 versus 14, right? So better in non-election years, even if it's not major, just slightly better when we're looking at non-election years versus net election years. Not enough to move the needle when it comes to decisions, when it comes to your investments, right? One thing that might be a bigger factor and something to consider is presidents that are in their lame duck fourth year presidency, when they're not running for election, that tends to be a little bit rougher on the markets. Why is that? What's driving that? Well, a lot of times lame duck presidents aren't worried about getting reelected, and so some of the policies that they push through might be a little bit different than those of a president who's looking to be reelected, and the decisions they're making, obviously they want the economy to be doing well, they want unemployment to be doing low, because those things become talking points if they're not doing well. Ultimately, though, where's the sweet spot in a presidency? It's their third year in office. Since 1950, that's when we've seen kind of the markets perform the best, not in the first, second, or fourth year, usually the third year in office. But does it really make that big of a difference overall? Are we trying to time the market? No, there's too much discrepancy between one president to the next when it comes to that. For example, this year is an election year. It is a fourth year of a lame duck president, but when he began the year, it was not a lame duck year for President Biden, right? He was seeking re-election. And this year, market's been volatile as it is every year, but actually doing really well when we compare it to a midterm year, a traditional presidential election year, or even a third year or first year, all the other years where there aren't elections going on. This year seems to be abnormal. And that's one of the reasons where we don't try and time the market, right? Because even though the numbers say, hey, it's an election year, maybe let's pull the money out, that doesn't necessarily mean that's what's going to happen, right? It's just an interesting piece of information for us to be able to digest and look at. Another controversial topic that comes up when I talk to people, especially this year, it's been, hey, if Trump wins, I want to get my money out of the market, or if Biden wins, I want to get my money, or Harris wins, I want to get my money out of the market. I don't think the market's going to do well. What does history tell us, right? During 94 years of a Republican president, market average is 8.2. 65 years of a Democratic president, 8.4. There's not a whole lot of difference between that 8.4 and 8.2. Right? Those are just averages. When we take all of the volatile years as a whole, it's almost identical, whether we have a Republican president or a Democratic president. A bigger or more interesting fact, I don't know if it's a bigger factor, right? When we have a Republican Congress, 13.4% market average, right? From 1950 to 2019, GDP doing well, Democratic Congress, GDP doing better, market doing worse. Here's the interesting thing. Split Congress, the GDP doesn't do as well historically in that time period, but the market does a lot better. Why is that? GDP and market are not necessarily tied directly together, right? We can have a recession and the market can be positive, or GDP could be doing well, economy as a whole could be doing well, and the market could be doing negative, right? But this 17.2%, this split Congress, leans back to that factor of a president seeking re-election, gonna try and do things that are good for the economy. People know the rules of the game. President not seeking re-election, pushing through some stuff that maybe he wouldn't otherwise do. A split Congress makes it very difficult to push through legislation that's extreme one way or the other, right? So having a split Congress tends to slow down the wheels of government for better or for worse. In this case, the markets tend to show us that that's historically been a better thing, right? Not necessarily the rule every single time, but it's a factor to look at, right? Businesses who are in business like knowing the rules of the game that they're playing. And that leads back to this. Where do earnings really come from, right? Politics or profits? This is one of our favorite charts to use as we're talking about what drives the market. And hey, the market's at an all-time high. Should I be investing? Should I not be investing? Guys, the bottom line is if businesses that you're investing in, whether that's a publicly traded business or a private business or your own business as a dentist or a doctor or a cabinet maker or a restaurant owner, whatever it is, you sell more falafels, you have more profit, your business is worth more. You do more drill and fill, your business is worth more. You have more procedures, your business is worth more. You build more cabinets, have more profit, your business is worth more, right? Publicly traded companies are no different. The difference is their dirty laundry is out there and aired for everyone to see, and there's a lot of people watching, right? But as earnings grow, the value of those companies tend to grow. This is one of the reasons we want you to know what you own and why you own it, and tie it into the fact that we want to invest in high quality companies that are profitable, that are growing their profits, that are well managed, because those companies will benefit from the fact of if they become more profitable, historically speaking, the companies are going to be doing a lot better, right? Because the broader market as a whole, that's what it shows us. No matter how long the time periods are on this chart, the trend tends to be the same. Companies become more efficient. Technology comes in. They don't need as many employees. There's more profitability. Regardless of all the other factors, this tends to be the thing that drives the market the most. So as you're looking at, is it politics? Am I making decisions based on who wins the election, who doesn't win the election? Our company is going to continue to make money. That's the more important factor from our perspective as we're building client portfolios and looking at making adjustments to those portfolios. Thank you for joining us. We appreciate your time. Those of you who weren't able to jump on the call today, we do these once a month. And for those of you who are in on the call, we're going to take some time now to answer your questions and go through some individual information. So, if you'd like to join us next time, sometimes we've got big groups, sometimes we've got small groups, and we can get to a lot of different individualized questions that we don't record, but that we put out there for those people who are able and willing to attend. Those of you who joined us, thank you. Those of you who didn't, hopefully we'll see you next time. Thanks.